Hey everyone, welcome back to Corporate Decoder, the place where we dig into those boring corporate filings so you don't have to. Today, we're diving into a supplement from Flat Rock Enhanced Income Fund, and trust me, it's a little drier than your grandma's Thanksgiving turkey at first glance, but we're gonna make it interesting, I promise. Alright, this document is basically a small update to the original paperwork for Flat Rock Enhanced Income Fund from April of the previous year, 2024. Think of it like a patch update for a video game, except instead of fixing bugs, they're tweaking fees and expenses. It's dated March 4th, 2025. The big news here is a change to how Flat Rock calculates its management fee. As of late February of 2025, the fee is now based on the fund's net assets, not its total assets. This might sound like accounting mumbo-jumbo, but it affects how much money the company takes to manage the fund. Before, they took 1.375% of the total assets. Now it's 1.375% of the net assets. Net assets means total assets minus liabilities like debts. It's basically what's left over after you pay all the bills. So this change could mean a little less money going to the management company, especially if the fund has a lot of debt. Of course, this is not a huge difference, but it's important to understand that the amount that the company charges to manage the fund is now being calculated on a slightly different basis. If you're curious about why the board of directors agreed to this change, the details are in the fund's report to shareholders that comes out around June 30th, 2025. That's where they'll explain their reasoning behind this new arrangement. This is not unexpected, because these changes have to be approved by an independent board, so they will make sure there is a good reason to change the way the fees are structured. Now let's talk about the fees and expenses associated with investing in this fund, as these are the numbers that will actually impact the bottom line. The document replaces the old fees and fund expenses section with a whole new one, giving us a clearer picture of where your money is going. First off, there are no shareholder transaction expenses, which is good news. This means you won't be charged extra fees just for buying or selling shares. But of course, there are still annual expenses, which are expressed as a percentage of the fund's net assets. This is where the bulk of the cost comes in. Management fees, as we discussed, are 1.38%. Again, this fee covers the cost of managing the fund's investments. It is calculated a little differently now, but the percentage is still basically the same. Then there are incentive fees, which are 15% of investment income. This is basically a bonus the fund managers get if they make the fund perform well. It gets a little complicated because it's based on something called pre-incentive fee net investment income, and there is a hurdle rate, but generally the better the fund performs, the more the managers get paid. So in effect, it is an incentive for them to deliver a return. Interest payments on borrowed funds are next, clocking in at 0.14%. This is the cost of borrowing money, which the fund might do to invest in more assets. As of March of 2024, they had some preferred shares outstanding, so this reflects the interest paid on those. Other expenses, which include accounting, legal, and auditing fees, plus compensation for administrative staff and payments to the independent trustees, add up to 0.72%. All the background stuff that allows the fund to keep running smoothly, but there's still costs that investors indirectly pay for. Finally, there are acquired fund fees and expenses at 0.02%. These are the costs of investing in other investment companies. Sometimes the fund invests in other funds. These funds have their own fees, so these indirect costs get passed on to the investor. Add it all up, and the total annual expenses come to 3.81%. That means that for every $100 you invest, $3.81 goes towards these expenses each year. This can seem like a lot, so it is important to keep it in mind and ask yourself whether the returns that the fund is delivering are worth the cost. To put these expenses into perspective, the document provides an example of how they would affect a $1,000 investment over time, assuming a 5% annual return. After 1 year, you'd pay $38 in expenses. After 3 years, $115, after 5 years, $193, and after 10 years, $397. Keep in mind that this is just an example, and your actual expenses may be higher or lower. Also, the disclaimer here notes that the numbers might not add up perfectly due to rounding, so don't expect to get out your calculator and match the values exactly. Finally, if you request your money via wire transfer, there's a $15 fee. That is pretty standard. Alright, let's zoom out a bit and look at the bigger picture. FlatRock Enhanced Income Fund specializes in investing in less liquid credit with a focus on niche markets and complex investments. So they could have good returns, but keep in mind that those returns might be more volatile and they might be harder to sell than more liquid assets. This fund isn't your typical stock or bond fund. They are trying to find some unique opportunities that other people might not be taking advantage of. Also, remember that a significant chunk of their expenses comes from management and incentive fees. The manager gets paid, but hopefully you get paid too, so it's worth evaluating their track record and deciding whether their investment style and performance justify the cost. Overall, FlatRock Enhanced Income Fund appears to be making an effort to be transparent about its fees and expenses, which is always a positive sign. The switch to calculating management fees based on net assets is a subtle change, but one that could benefit investors in the long run, especially if the fund uses a lot of borrowing. The fund is definitely not the cheapest option out there, but if they are finding unique and profitable opportunities, then the costs might be justified. One thing to watch out for is the fund's reliance on less liquid investments. These can be harder to sell quickly if market conditions change, which could potentially impact returns. Ultimately, whether or not FlatRock Enhanced Income Fund is a good investment depends on your individual risk tolerance and financial goals. Thanks for tuning in to Corporate Decoder. If you found this breakdown helpful, please hit that like button, leave a comment, and subscribe for more insights into the world of corporate finance. Until next time.